So welcome to the next panel event. This is a session on liquidity, mastering the angel exit. My name's Tom McLeod. I'm a partner in the corporate and venture capital team at Harbottle & Lewis. We are a London-based law firm, very well known for technology, media and entertainment. What I'm very proud of, though, is that we are a one-stop shop for early-stage businesses, founders of those businesses and investors into those businesses. And we do everything for those businesses through the life cycle, right through from inception to exit. But we also look after the people behind the businesses. So whether it's founders, angel investors or high net worth individuals, we can also do everything that they may need in their personal capacity, whether that's property matters, family, tax planning, estate planning, etc., etc. So you don't need to go anywhere else for your legal needs if you're in the kind of startup and venture capital ecosystem like we are. That's what we like to think anyway. Okay, great. So we've got with us Pamela, Nick and Henrik, and I think I'll hand over to each of you to introduce yourselves first because you all know yourselves much better than I do.
You want me to go first?
Sure.
I'm Nick Button-Brown. I've been in the games industry for 30 years. I had a couple of startups. Some of them worked, some of them didn't. I spent a lot of time at Improbable, learned a lot. I learned a lot. I set up the Games Angels, partially because the people that would be most helpful to me had been the Angels. They were the ones that when it was all turning to shit, they were the ones that went, yeah, it's gone to shit, hasn't it? It's like, yeah. So I set up the Games Angels. We've done 35 investments. I'm 53, so I'm clearly on the decline as an angel investor. And yeah, I'm current UK BAA Angel of the Year for about another couple of weeks.
My name is Pamela, so I'm the founding member of Pachamama Capital. Pachamama is a secondaries fund focused on providing liquidity solutions to founders, early employees, and angels of pre-unicorn companies onwards. So our mission is to enable top talents with liquidity so they could continue building their next disruptive technology. So this fund is inspired by my experience as investor in both equity market and early stage companies, as well as my time as founding member of Alibaba Group and Alipay in Europe, where I launched and scaled the business to more than 10 countries in Europe, Middle East, and Latin America. So that's me.
Awesome. Hi, everyone. So I'm Henrik. I'm currently a partner at a VC fund called Playfair, based in London, investing in pre-seed all across Europe. But before this, I actually got into VC by being an angel investor. So I started out doing crowdfunding, like many people probably have done here in the past, and have kind of done about 40 investments through that, through to quote-unquote proper angel investing with like individual tickets before Playfair and then through Playfair now. I also founded a startup back at university. So not what a lot of founders in this room probably have done, but you can still learn a lot of the empathetic side of how hard it is to actually get something out of your head and build it. Hopefully you can share a bit of the angel mentality as well as the VC mentality.
Great, and this lot have invested in the likes of Monzo, Revolut, GoHenry, and OpenAI, so listen carefully to their advice, I would say. Great, so when we're talking about angel exits, well, what do we mean? Well, obviously there's the more traditional route of a company that an angel has invested in selling, whether it's a share sale or an asset sale to private equity or to a trade buyer. Also, if you're very lucky, obviously there are IPOs very occasionally, not so occasionally in the UK these days, sadly. But also there are more and more secondary transactions in the market at the moment. And that's a nice segue, I think, to talk to Pamela a bit more about Pachamama. Pamela, why did you start Pachamama and how do you think it presents opportunities to angels?
So there are like different reasons. So I started doing angel investing 4 years ago. I didn't know where to start, so I joined a few different syndicates across UK, Europe, and also US. And roughly 1.5 years ago, I saw these opportunities mainly from the US side. So I received some like very late, I wouldn't say they are late, they are just very like fast growing companies, like OpenAI, like also pick these companies. so I received like invitations from like syndicates. They invited us to invest in these companies. So after 15 months, so I started investing in like secondaries roughly 15 months ago. Now the multiples is roughly 3 times, and I just realized that compared to early stage, this is more like an asset class which is more controlled with probably less risk and more predictable outcome. So then that inspired me to set up a secondaries fund. But so I wanted to extend it to not just like pre-IPO companies, which is already perhaps overvalued. My ethos is really to back founders and early employees, because during my Alibaba time, I came across many like inspiring entrepreneurs. My father is also an entrepreneur, so I always wanted to be an entrepreneur. I couldn't be because I feel like I haven't had a good idea. So but what I can do is to back them with my network, my experience, and perhaps my funding as well. So I wanted to extend the idea of secondaries to pre-unicorn companies, and I would like to back them like personally, so not to just through VCs, but I would like to provide the liquidity to founders, early employees, and angels. So that's the ethos, yeah.
And in terms of how you structure those secondary transactions, so we see in the market sometimes some funds who are creating some pretty funky structures when they're doing those secondary transactions. Do you do that, or do you just tend to keep it simple for angels in particular that are looking to exit?
So I've seen them on the market. But so our approach is that we are not trying to buy out founders, because we are there to enable them to continue building their business, right? So they might need the funding just for personal reasons. They might need to pay the tuition fee, which is very expensive now, or just buy a property. So we don't, like, it's there, the money is there to make sure they can continue with their daily life so they don't get distracted. So for founders, if they actually come to me and say, hey, I want to sell you 30% of my shares, I would say, no, thank you, because it indicates that something is wrong with the company. For angels, I came across some angels, like actually from Silicon Valley. So just one example, he used to be the partner of Sequoia, and he did this angel investing in one company. In 3 years' time, it became a unicorn company. And he came to me, he said, yeah, I just want to sell all to you. For me, that's okay. I asked him why. He said he's very disciplined. So once he achieved 10 times, he just sell them and recycle the capital and continue investing in the next company. I guess he has a very good deal flow. So that's something, we do like direct and a straight approach.
Got it. And Nick, Henry, can you tell us about an exit perhaps that you've experienced? What type of exit was it, and what lessons have you each learned?
I had a surprising one. Who uses SPVs for investments? Sometimes. Okay, yeah, I'm in the sometimes category. Normally I like to do it directly. I ended up with an accidental exit. And it was a follow-on round for a company, and they had a fixed allocation in that round, and we're allowed to carry on. But some of my co-investors were so excited and really wanted to overinvest, and I kind of had lost faith. It was Web3. Yeah, we all make mistakes. And so actually, just as part of that transaction, I sold my share to my fellow investors. And that was kind of really surprising to me. It was actually an exit after about 8 months, and I was quite happy with that. So I won't increase my SPV percentage massively. I'm not going to do all my things, but it was a nice, comfortable way to get out with very little legal paperwork.
Get out quickly.
Yeah.
And then maybe talk about a couple of examples, maybe one later. So through crowdfunding, obviously slightly different the exposure you have and the access, but to me, at least 10 years ago, it was a way of getting in. So I was in early Monzo and Revolut rounds with very small tickets. I was a student, so just to put it in perspective, I'm very far from being a millionaire, sadly. But we talk about Revolut as a secondary example later, maybe. Free Trade is a really interesting one. There's probably someone in this room that's also invested because they had a lot of crowdfunding investors. On the first check I did in the first round, I think I got an 8x return. On the last check I did in the follow-on round, I lost 87%. So it really goes to Chris's point about timing. And obviously you can blend those over multiple rounds, but I think you've got to think about what is your time horizon, what is your scope for kind of what are the returns you're looking for, and honestly probably be more disciplined about stopping after one or two rounds. It might also be worth kind of mentioning that most startups go in this journey up and down. It's very rare for everyone to just go up and to the right. And when it goes down, usually institutional investors put in more investor protection. So like you've probably heard of liquidation preferences. That basically means that those institutions are going to get a slug of money back first and reduces your exit, sometimes to zero if they're really punitive. So in that case, it actually massively reduced all of the crowdfunding and angel investors' returns. So it really depended when you got in, whether or not you made money or not.
And you may have just touched on this, but what do you see as kind of common pitfalls that prevent successful exits? I think like a very aggressive pref stack on the cap table is something that I've seen, particularly if the founders are well below that, then it's just going to be difficult to get a deal away which keeps the founders happy.
Yeah, I mean, maybe to talk to one of our, obviously I won't name them, but through Playfair, through our VC portfolio, which obviously had angels in it as well, about 3 or 4 years ago, the founders basically got to the point where like, we want to sell. You know, our head's not in it. We've been building for a long time. We want to kind of liquidate a little bit of our wealth, and they tried to sell. It doesn't really work. It does sometimes if you're lucky, but you have to build almost with the assumption that someone will come to you because of a position of strength. If you try and set yourself up to sell, it very rarely works out. And so what they ended up doing is running an M&A process. Nothing happened, and they had to kind of go back to square one, rebuild, took 2 years, and then there was a strategic acquisition that ended up happening. In the meantime, though, they had to take on more funding with quite an aggressive pref, which meant that it gave them another 3 years to be able to kind of outgrow that, to even be able to make back the money that they would have to get over the hurdle of. So I think it's an interesting example. As an angel, do you have that much influence on, you know, that part of the journey? Not really. But when you choose the founder, you can make a judgment on what are their ambitions, how are they going to build the company. You can ask them about how they think about exits under various scenarios. So,
how about you, Nick?
Kind of make yourself useful. I mean, yes, so angels, lots of angels. If you're on a large crowdfunding table, it's hard to make yourself useful. But a lot of the companies I work with, in Outright Games, that was my biggest exit. We ended up at kind of 18x. But I was useful, and so I'd kind of tapped up, and you know, the CEO was quite protective of me because they wouldn't have got to where they would have got without me. And so it meant actually I was treated well in the round and ended up rolling into the next round. So there is an element of karma. You know, if you help them out, you help them out without expecting any particular return. You help them out because it's the right thing to do, and it does come back. I know that, sorry, that's not a very legal response, is it? It's just trust. Put trust in your CEOs. But yeah, I mean, you've worked with them for years. You know, by the time you're at an exit, you've been through all kinds of crap with them, and yeah, you know, they're with you. They're your friends.
Yeah, non-legal is always a good option if you can avoid it. I think it's safe to say. You touched on this earlier, as syndicating versus non-syndicating. What's your experience been of investing directly versus in a syndicate, Nick, and anyone else on the panel that's done it?
Yeah, I mean, I do. I yo-yo on this quite a lot. I think syndicated investment is a great way to get a more diverse set of investors. It's a great way to allow smaller checks. But I always feel slightly less connected to the companies. Where I'm directly on the cap table. And I know there is no reason why this should be true. You know, it's down to the communication. Of course you can overcome it. And I've never managed to overcome it. So the direct investments tend to be the ones where I feel personally involved. I'm giving them help. I'm talking to them. They're calling me to tell me that everything's gone to shit. And I'm going, yeah, it does, doesn't it? So it's completely subliminal, but I'm much closer to the companies that I invested in directly.
I guess on the flip side, if you're in a syndicate, you might be able to get more of a stake together. You might get a bigger percentage on the cap table, which might help you out in terms of negotiating director rights, observer rights, information rights, things like that.
I mean, there's a couple of things ongoing, and I'm not gonna preempt the conversation that we'll have a little bit later. You're over there. There are things now where you are getting assistance and support and matching because you're in a syndicate. Those are quite important. Then your money gets multiplied by 1, 2. There's one particular company that I worked with, we put in 200K, and she managed to make that into 1.4 million with a series of grants and matching. And definitely the people that are working it now, there are ways to work those rounds to really take a little bit and make it into much, much more. But that can be a good reason for an SPV, because a lot of the legal ramifications around that are helped by being an SPV.
Yeah, very much so. Henrik, coming back to you, I understand at Playfair, you get 70% of your portfolio companies from pre-seed to Series A, which is very impressive. How do you achieve that miracle, and how have you got any advice?
No, I'm paying attention now.
Have you got any advice to the room on that?
This is the humble point. Honestly, it is not about being smarter, it's just choosing your strategy. So some very smart people before have gone on and said you need to have a massive portfolio. I totally agree, by the way, but there's different ways of maybe constructing that portfolio. So we as a VC compare ourselves maybe to a seed camp, which I'm sure everyone's heard of. They make a large number of investments, assuming a smaller percentage will get to Series A as a kind of benchmark of have they found product market fit, have they got a real team, have they got real product, and can they raise growth capital? For us, we say we'll invest in much less, so we only have 25 companies in a fund versus maybe 100, but we kind of have to have a higher percentage that get to Series A to then at kind of Series A or B stage have actually the same number that then go on to have a shot of reaching the 50, 100x. So what we do is just allocate far more time to the kind of diligence in the broadest possible sense. And it's not that we are smarter than investors at Seedcamp or anyone else. It's just that they have a process that's probably 2, maybe 3 meetings. They may or may do a reference call. We'll probably still only do 3 or 4 meetings, but spend probably 2 whole weeks of 3 people on the team every single hour of the day, plus maybe 10 to 15 references from people who could use the product, who've used competitive products, other founders, go a lot broader with basically 2 heuristics. What is the route to product market fit, and how much of those founders thought it through? For us, we feel like that bakes in all of the underlying pillars behind what goes into an investment memo. And to date, since the beginning of Fund 2, we've essentially managed to maintain this kind of 75% graduation rate from pre-seed to A. And yeah, I just want to reiterate the point to everyone in the room. Yes, you're not going to have the time or resources to have a team of 5 people doing this every day, every hour of the day, but come up with your own strategy and lean into it. And it helps us win deals. But ultimately, we end up kind of at the same point as a much broader portfolio. It just depends where you look at it.
And what about Stephen's psychometric testing? Do you do that?
We've thought about it a lot. We actually don't. We try and come up with other heuristics that are equivalent. So we've honestly stopped the idea of doing it purely because of winning, actually. We feel like it introduces a friction in the process that is sometimes a little bit uncomfortable. Whether or not that's true, others could debate. But we do have like 8 founder traits that we really look for and measure against. Things like resilience, actually, humility, speed, things like that. So it's an equivalent.
Interesting. Something I might think about doing in future before we take on new clients. Coming back to Pamela, what do you think about angels specifically investing with secondaries as an exit strategy in mind? Do you think that's realistic?
So in my experience, when the company reaches like Series A, normally I know like in Series B they say sometimes like tender offer like provided by the new investor buying for different purposes, maybe to incentivize the employees or to clean the cap table from previous investors. So that's a good time, maybe Series A, Series B, when the company is fast growing, that's a great time to start thinking about the secondaries. But I feel like recently when I speak to some founders, it's almost like they haven't realized there is an option. So for angels, it's quite important to maybe be upfront, and maybe when you are putting your check, you can already discuss with the founders, just to put this in their mind, telling them that, oh, you might be thinking about a secondary sale in a couple of years' time when the company reaches the inflection point. So that's something, as an angel, I think being proactive, be upfront with the founder, and keep good conversation with the founder. I think just touching on your point earlier is a very important way of getting yourself in the game of when there is a tender offer.
I do think angels have a lot of impact on the chance of an exit. We're having conversations here. We're setting up conversations. Go back to a company founder who, maybe they need some money to buy a house or kids of that right age. And so we can set up those conversations. We can't make them do it, but we can give them the opportunity to make that decision for themselves.
Mm-hmm. Mm-hmm. And I'm just conscious of time. We're in the last few minutes now. So I would like to ask all of you how you see the exit landscape at the moment, how it's kind of changed in recent years, and what are things you need to be thinking about. I mean, from my perspective, obviously on the deal side, we are seeing some really complicated deal structures at the moment where buyers are being very, very cautious. They might do a partial buyout with call options to buy the rest of the company. Lots of diligence, very, very slow process, painful. I mean, good for the lawyers, you might say, but it's they're complicated transactions, and it's a difficult market to get a sale away in, I would say. But yeah, interested in your views.
I suppose maybe 2 points. One is that we see obviously everything pre-seed to be in particular detail and a little bit beyond. I'd say at Series B, our companies that raise those rounds, at least 50% angels are offered some liquidity. And that's consistent, maybe not in the real dregs of 2022, but anywhere where it's a neutral or positive market. Mm-hmm. So I'd say there really are opportunities to get some liquidity, particularly if you are smaller. The smaller your check, the more option you have because it's not having such an impact on the cap table. Mm-hmm. So that's kind of one point. I think the other one is actually just to go back to the Revolut example, because I think it's interesting. Taking liquidity when you can. So again, it's not huge sums of money, but essentially 18 months ago, there was an option to go on the seeded secondary market and say, okay, I'll sell it at a discount. And at that point, it was 60% of the last round valuation. And I said, having learned a lesson through kind of my day job, when you have an option, just take some liquidity. Basically, the heuristic is, for me at least, if your stake is worth your portfolio size or your fund, take a third, because you don't know when the opportunity is going to come up. So when I did that, I think it was a 20x return on the first investment. Then obviously there was a lot of news everyone's seen in the last 4 months ago maybe, about a lot of investors being offered liquidity at the last round valuation. Sold a third then, there was, I think, 70x. So you could say you left a huge amount of money on the table. And yes, in a way I did. But you don't actually know that opportunity is going to come about. And actually when you blend together the various exit prices, it trends upwards if things happen well. If it goes down to zero, you've missed your opportunity. And I think if people know like the free trade story, there was an option to sell one round before that very, very few people took. So my key lesson here is that like secondary opportunities do exist. Don't be greedy and take something sensible like a third, or have a rule that you stick to.
Nice.
Yeah, I think I'm in line with what you're saying. So just a personal experience. So I mentioned earlier I was like one of the founding members of Alibaba and Alipay. I joined Alipay quite early when they just entered Europe. And when I was leaving the company, the company policy was just for me to sell my shares back to the company. Before that, we also were offered many times to sell our shares. And we were all like joking, like, who would sell our shares? That's stupid, right? We should just wait for the IPO. Then the IPO didn't happen because, it just got pulled out one day before the IPO. So that's just a very personal experience to show that when we were like offered the opportunity to sell some of the shares, we should just take the opportunity. The other idea is to maybe look at the companies which could be acquired. So not just waiting for the IPO. Some companies, there are some signs. So for example, if a CVC, corporate VC, invest in this company, and then they have the history of acquiring companies that they have invested in, maybe that's another way to consider your targets for angels as well.
So I work only in one sector. I work in games. So I don't know if this applies to other sectors at the moment, but if you're looking for an exit right now, I'd say don't. Hold on for another 2 years. Now is the time to be buying. One of my exited companies, we're going around on the M&A pipeline and taking advantage of a couple of the companies whose cap tables are absolutely destroyed, and being able to buy them for pennies on the pound. So now is a time to be able to, if you still have some cash, be buying now, be putting money in, be adding a little bit extra on the basis that it'll turn around in a couple of years.
Just a final point maybe on that is I think entry price kind of got brought up earlier, and you're kind of alluding to kind of putting money in maybe at not necessarily a low price, but opportunistically. I think most of the exits, if you do a distribution, just go on ChatGPT and ask it. Most exits are probably in like the 50 to maybe 200 million range, very broadly. So think about what return do you want, and that back solve it. Yes, there can be these huge outliers, and yes, those do drive a lot of returns. But just think about what kind of angel investor you want to be, what kind of return profile you're looking for. Because if you don't define that before you go in, how on earth are you going to actually be able to figure out anything to do with liquidity and have any kind of planning there? So it's just worth bearing that in mind. And it's very different between sometimes an angel mindset and a VC mindset. Both you can make money in very different ways.
Yes, good point. I finally wanted to mention Pisces. We don't actually have time to talk about it now, unfortunately. I don't know if people are familiar with Pisces. It's the London Stock Exchange's new market for private companies, which is going to allow investors to essentially sell to public markets without those companies being listed. So it's a very interesting development. It's supposed to launch this summer, and we can continue chatting about that in the pub maybe later, if anyone's interested. Cool, that's it. Thanks very much.
Thanks, everyone.
Cheers, thank you.
Cheers. Thanks a lot.
Happy to-